After the shock of 1980 and a period of stepping back, George Soros returned to the financial markets in the mid-1980s. But this time, didn't approach the markets the way he had before. He wasn't just looking at stocks. He wasn't just looking at bonds. He was looking at the entire monetary system. At the time, several key dynamics were in play. Under President Ronald Reagan, the United States pursued expansionary fiscal policies. While maintaining high interest rates, which drove the US dollar sharply higher, many believed a strong dollar was a sign of a strong economy. Soros saw something completely different. He believed the US dollar was overvalued, and sooner or later it would have to correct. Based on that view, Soros built a massive position long the Japanese yen and the German mark, short the US dollar and oil. This was a large-scale macro bet, one that wasn't based on a single market, but on imbalances across the entire global monetary system. On September 22, 1985, a major event took place, the Plaza Accord. Leading central banks coordinated to intervene and push the US dollar lower, and what Soros had anticipated began to unfold. The result? The dollar fell about 13% in just 1 month, and roughly 25% over the course of a year. Soros made around $150 million, with returns of approximately 122%. This wasn't just a successful trade. This was Soros's comeback. After his failure in 1980, many had doubted him. But this trade proved one thing. He didn't just understand markets. He understood how governments and central banks operate. What's important is that Soros didn't predict the Plaza Accord itself, but he understood that the system was out of balance and that a correction was only a matter of time. That's how he invested. You don't need to know exactly when, but you need to know what cannot last forever. The 1985 trade marked a shift in Soros's thinking, from a skilled investor to a player operating at the global macro level. And from that point on, his bets didn't just impact his fund, they had the power to move the entire world market. Late September 1987, George Soros's quantum fund was up 60% for the year, 60% in 9 months. That's a number most fund managers wouldn't dare dream of across an entire decade. And Soros, the man born in Budapest, who survived the Holocaust, who built a financial empire from nothing, was standing at the absolute peak of his career. But markets have a way of humbling. Even the greatest. Soros entered that year with a conviction he was certain about. The Japanese stock market was a bubble. Tokyo equities had been driven up too far, too fast, fueled by hot money and herd mentality running completely on fumes. He shorted Japan. But here's where it gets interesting. At the exact same time, the quantum fund was long the American market, betting on Wall Street going up. To Soros, the logic was airtight. If Japan crashed first, global capital would flood into the US as a safe haven. Wall Street would surge, quantum fund would win on both sides of the trade. It was a genius strategy. If the sequence played out the way he expected, the market didn't care about his script. October 14, 1987, 5 days before the crash. Soros had just published an op-ed in the Financial Times, doubling down on his thesis: the crisis would hit Tokyo, not New York. That call would age terribly and fast. That very same day, Wall Street started cracking. Then the 15th. Then the 16th. The market bled out slowly, like a building quietly losing its foundation before the whole thing comes down. Soros watched his portfolio and faced every investor's worst nightmare, both sides of his trade moving against him at the same time. October 19, 1987, Black Monday. The opening bell rang in New York, and the market fell off a cliff. The Dow Jones dropped 22.6% in a single session, the largest one-day percentage decline in stock market history, a record that still stands today. the largest one-day percentage decline in stock market history, a record that still stands today. The crash Soros had been warning about finally arrived. It's just not where he thought it would. Quantum was short Japan, but long the US market. When Black Monday hit, the Japanese short initially appeared hedged, but then US equities bounced. He was trapped, unable to exit, unable to adjust, watching the damage compound by the hour. Then came the decision that sealed it. He offered 5,000 S&P futures contracts, and there were no takers. Liquidity had essentially vanished. Other traders saw exactly what was happening. A man holding massive positions, forced to sell into a broken market. The hunter had become the hunted. In a single week, the Quantum Fund lost 60%. Let that sink in. Everything built up since January, gone in 7 days. Stanley Druckenmiller described the moment bluntly. He was on leverage. And the very existence of the fund was threatened. Soros didn't break. Within weeks of Black Monday, he spotted the dollar was overvalued and placed a heavily leveraged short against it. The dollar fell. The trade worked. Quantum clawed back most of what it had lost. By year's end, the fund closed 1987, up 13%, having been deep in the red just 2 months earlier. Most legendary investors would have needed months of therapy just to get back to their desk. Not Soros. He was back at the table in 2 weeks. Druckenmiller noted that nearly every manager he knew who got caught in that crash became almost comatose afterwards. Non-functional. And I mean legendary names in our business. Black Monday didn't teach Soros that he was wrong about markets. It taught him something far more uncomfortable. Being right about the direction isn't enough. You have to survive long enough to be proven right. 3 things kill investors. Not bad analysis, but these. Too much leverage, dried up liquidity, and a market that refuses to follow your expected sequence. Soros got hit by all 3 at once, and he was big enough to admit it, to sit with it, picked up, to learn from it, then walk back into the ring just weeks later. Not reckless, but recalibrated. That's the difference between a trader and a legend. A trader blows up and walks away. A legend blows up, figures out exactly why, and comes back a sharper version of himself. After a series of major events in the 1980s especially, Black Monday George Soros began to realize an important truth. He couldn't play this game forever. The complexity of the market was increasing, the fund was growing larger, and the psychological pressure was becoming heavier. Soros quickly understood that, to keep advancing, he needed someone who could share and eventually replace his role, but that wasn't easy. He wasn't just looking for someone talented. He was looking for someone who could think big, who was willing to make big bets, and who wasn't constrained by theory. That person was Stanley Druckenmiller. He didn't fit the typical Wall Street mold he hadn't attended. Prestigious Ivy League schools, grew up in a modest family, and had taken on various manual jobs, even selling hot dogs at one point to make ends meet. What set him apart was his ability to read the market and make quick decisions. By 1988, Druckenmiller's fund was among the best performing in the industry. Soros recognized it immediately. After a period of working together and mentoring, he made a decision that was almost unheard of in the financial world. He handed over nearly full control of the Quantum Fund to Druckenmiller. This wasn't just a personnel decision. It was a strategic move. Soros understood, to win in the long run, you can't rely on a single individual. You need a system that can keep operating even when you're not directly in control. What's interesting is that the relationship between Soros and Druckenmiller wasn't the traditional boss-employee dynamic. You can probably picture it. Druckenmiller had the authority to make major decisions, but Soros remained in the role of a challenger, questioning, testing assumptions, and sometimes pushing for even bolder moves. And that's exactly what made this duo so exceptional. Entering the 1990s, The Quantum Fund was no longer entirely dependent on George Soros. Under the management of Stanley Druckenmiller, the fund didn't just maintain its strength, became even more effective. Performance growth accelerated. Investment decisions became increasingly bold, and the fund's scope continued to expand. Of course, this reflects a larger truth. Soros' strength wasn't just in himself. It was in the system and the way of thinking he built. During this period, Soros began to shift his focus. He was no longer solely concentrated on making money from the markets. He became interested in soft power. He founded the Open Society Foundations, a global network of philanthropic organizations. His goal was to promote the idea of an open society, a concept he drew from philosopher Karl Popper. This idea is characterized by accountable power, protected individual freedom, and institutions that can be questioned. Soros funded a wide range of initiatives: education, human rights, and political reform. This made him one of the most influential figures, not only in finance, but also in global politics. However, not everyone viewed this positively. Some argued he used philanthropy as a way to expand his influence and to gain access to political leaders. Regardless of perspective, one fact is hard to deny. The Quantum Fund continued to succeed even after Soros stepped back. And that was due to two key factors: the intellectual foundation he created and Druckenmiller's execution. The period after 1990 wasn't just a continuation. It was a new era, a time when Soros was no longer just an investor. He became a figure of global influence, starting from money to ideas to politics. It was a transition that very few investors have ever been able to achieve,